Get ready for what I'm about to say. What makes whale sperm, codeine, and elevators more special than racehorses, ketchup, and video games? If I haven't gotten your attention yet, you might want to continue listening in now, because the first group is considered essentials. The latter, non-essentials, at least in Venezuela. President Hugo Chavez devalued that country's currency, the bolivar, last week by as much as 50%. And under this new Forex exchange regime, items considered essentials, like whale sperm and codeine, will get a preferential rate. The devaluation itself spurred a buying rush among local consumers who were trying to go out and stock their own shelves before prices jumped, before inflation set in. That also led to ratings downgrades for some multinational companies who have significant businesses inside that country. So what does this all mean for you, your portfolio, for the outlook for trading in Venezuela and South America? For that, we turn to Rafael de la Vega. He's chief economist for Latin America at BNP Paribas. Good morning to you, Rafael. It's sort of a funny note to lead into a very serious conversation with, but the headlines did seem odd here. When you go through the listings of what's essential and what's non-essential, those companies that are going to be affected by this devaluation are coming more clearly into focus. Who's going to be most affected here?
Well, I think most companies that can't get access to preferential dollars are the ones that are going to be most affected. But what we've seen in Venezuela over the last few years is that a lot of companies, even under the old regime before this devaluation, couldn't get access to official dollars at any rate. So it really depends on whether this government makes more dollars available at whatever of these two exchange rates it decides to support. If it doesn't, then you're going to see the black market become the mechanism of choice for all agents in the economy, including some of the corporations you mentioned.
Well, we see the specifics here. Importers of essential items will pay 2.6 bolivars per dollar. Those that are non-essential will pay 4.3 per dollar, is what I've seen.
Right, but that's all academic. I mean, at the end of the day, what really matters is, will they make dollars available at this official rates, whether it's the low rate or the high rate? Most companies, and a lot of companies in Venezuela, would be happy to get that oil rate, because many of them weren't getting that before. They were forced into the black market or the parallel market, which trades higher than even that oil rate you mentioned.
Now, in your latest note, you're highlighting that the large size of this devaluation by the Venezuelan government indicates some real meaningful fiscal problems there for the government. What does this specifically raise a red flag to you about?
Well, basically, no government in Venezuela ever wants to do the sort of devaluation they've just done. Clearly, Venezuela, the government, the treasury, benefits greatly from a devaluation because they own one of the biggest oil companies in the world. So when they devalue, they generate a lot of cash flow for the government. But it kills the population. You're going to see an increase in inflation, and a lot of people are going to be hurt by this. So it's not something you want to do. And the critical thing now for this administration is to try to keep inflation down. That's going to be very hard unless they tighten their fiscal belt. And that's not something that this government is likely to do. So what you're going to see is higher inflation in all likelihood, rising pressures for further depreciation down the road.
You highlight that trying to get control, practicing fiscal restraint would also include increasing the price of domestic gasoline. I mean, these are essentials. These are day-to-day items for consumers there. I mean, the absolute extreme you would point to then is just what it's going to do to a consumer's daily life there, and the question of how stable the government might be.
Right. Well, I mean, if you want to fix a fiscal problem in Venezuela like the one you have currently, you have to devalue and you have to tighten your belt. The best way to tighten your belt in Venezuela is to raise domestic gasoline prices. Domestic gasoline prices in Venezuela are heavily subsidized. But as you point out, these measures all contain risks and all contain problems for the population. And therefore, it's controlling the social unrest and the reaction to that might lead to problems in Venezuela down the road.
Rafael, it's a topic we're going to continue to follow here on In Business. Thank you for giving us your analysis, and I do want to continue to follow the spillover for what it means to putting your money to work in Latin America right now as well. Thank you for joining us.